Hello, everyone. We're glad you could join us today. These are certainly unprecedented times for the medical community, and for that we want to thank you and your colleagues. We understand these are challenging times impacting all of your lives in very different ways. Whether you're on the front lines or have seen a significant reduction in practice, we are here to help you navigate through what is available to help you with financial impacts. I'm your moderator, Lee Rado, Regional Vice President from the Prairies based out of Winnipeg. I'm joined today by my colleagues Craig Maddock and Kim Peterson from MD Financial Management. Craig is responsible for the management of more than 40 billion in assets held in client portfolios, as well as MD's proprietary mutual funds and pools. With a career spanning more than 30 years in the financial services industry, Craig has developed his expertise in the management and delivery of high-quality investment solutions through various roles in investment management, sales management, estate planning, and financial planning. Kim Peterson is a senior financial consultant with MD Management Limited. She has nearly 20 years of experience in the financial services industry, developing customized financial plans and helping her physician clients and their families achieve their financial goals. We have a lot of content to cover. Our goal is to try to get through the presentation in about 30 minutes and then to answer questions during the last 15 minutes of our hour together. This session will also be recorded and sent to you following the presentation. So please submit your questions via chat during the webinar. On the right-hand side, you should be able to log those questions. We'll do our best to try to answer as many as possible at the end of our session. But to get started, we are gonna do a little bit of fun polling. Usually a good way to start the webinar. So if you can just watch your screen and participate. The first question is gonna be around who is on the call. So please log your response. I'm gonna give about 10 seconds or so. It's always nice to see a cross section. All right. I will close this poll out and share the results in about 3 seconds. And move on to the next poll. So we have mostly practicing and retired physicians online. All right. Next poll. So what is your biggest concern when it comes to the pandemic? Again, log your question. Right. And certainly we have the right gentleman on the line here today for those concerned about the markets. And certainly we have a good cross section of answers here, which I will close out and share with you now. Okay, we'll move on to our final question. What is your biggest concern when it comes to your finances? All right. Retirement and investment performance seem to be concerned. I'm going to close this one out in 3 more seconds and share. All right. Thank you everyone for participating. Nice way to start and get a little idea who's in the room and what we are all thinking about and concerned. So as we will try to touch on some of these feelings during our discussion. But at this point, why don't we pass it on to Craig to get us started.
Great, thank you very much, Lee, and thanks everyone for joining us tonight and for the opportunity to speak with you. Seeing the concerns were around investment performance and your ability to meet long-term retirement, certainly the current events of the markets are having an impact on both of those concerns right now. So I'll do my best to address what's happening, really kind of an update as to what we've seen so far this year, but I think more importantly, what we see going forward and how we position portfolios to try to navigate what we believe is the result of the COVID-19 dilemma on the economy and ultimately on the stock market. So on the next slide, you're going to see Don't get shocked. This is as of the end of March, just so that we can get a perspective as to, the sort of the tale of 2 quarters. We're almost finished the second quarter, but as of the end of March, which was pretty much the bottom of the market. Markets bottomed out, stock markets did, around March 23rd this year. They peaked about February 19th. So in reality, we started off 2020 a very strong year with market performance. In fact, many stock markets, including the US stock market, had hit their all-time highs as of February 19th before they started to turn down. And as of the end of March, we were staring at some pretty abysmal stock returns, especially off the back of 2019, which was a very strong year for stock markets. We turned off this year, obviously, with a pretty bad start, which I don't think is a surprise to anyone, given what we've seen with the impact of COVID-19 and its impact on not just the stock markets, but really on the economy and the way we live our daily lives has been impacted profoundly. So I'd say that somewhat good news is that when you look at the next slide and you see where we are as of not quite the end of the quarter, but as of June 22nd, and sadly, if I updated this chart every day, you'd see these numbers move around a lot. We're continuing to see quite a bit of volatility in the markets, which is really a measure of uncertainty, and we'll show some slides later around what that kind of looks like. But markets are still bouncing around a lot as market participants are trying to digest new information as new information becomes available. But good news, I guess, to some degree, is if you look at the far left bar, you're seeing that's a representation of the bond market. So far, bond markets this year, as of the end of June, are actually up about 7%, which is very interesting given the fact that interest rates are now close to the lowest bounds they've been for an extended period of time. And in a lot of ways, we talk about interest rates at near zero. They're not quite zero, but they're very low. In some parts of the world, they're in fact negative interest rates. And the reason that we're seeing a strong return on the bonds in the second quarter of the year so far is because interest rates have come down quite substantially in that period, which in the way bonds are priced means the bond returns were actually quite strong. The challenge, of course, is we could not repeat such a thing because interest rates, quite frankly, can't fall much lower than they already are and are expected to stay low for an extended period of time. I'm going to call it the somewhat good news is that in contrast to the first quarter, when we were seeing markets down around 20% year to date, we're now down, call it only 6, 7, 5%, depending on the international markets, and US markets are slightly positive in Canadian dollar terms on a year to date basis. So a lot of the pain that we saw in the first quarter has been recovered. We by no means have recovered to pre-COVID levels or at the beginning of the year, February, but we have seen quite a bit of recovery so far in the markets, which is a good sign for what we hope to see in the eventual continued recovery of the economy and ultimately support for markets. And in fact, when I talk about that, collapse and then maybe the recovery or slight recovery we've seen so far through to the end of June, on the next slide, you'll actually see kind of how profound this really has been. This is an example of bear markets. So when we think of a bear market, it's typically a drop in stock markets of over 20%. And we've just looked at historical bear markets, so the average bear markets through time, the average corrections through time, and then the current. And the way this chart's represented, the middle of the chart is basically the beginning of the decline. The left-hand side is so basically 1 year period coming up to the peak of the market. And then you see the decline and the subsequent recovery as to where we are today. So I think it's very interesting when you look at the average bear market, and actually if you look at current relative to average, the 1 year preceding the bear market, this one in particular, looks pretty much average. A little bumpier, a little choppier perhaps, but generally when you started a year before to where we ended up, the uptick in the market generally in line with what you'd expect. A pretty strong market is what you see prior to most bears. Oftentimes in a bear, though, you see a more prolonged contraction. So you start to get some bad news come out, perhaps the economy slowing down, you see policymakers stepping in and increasing interest rates, or maybe some other responses, but generally it's a gradual decline, maybe in a few phases or a few waves as we sort of settle through things. You can just note the speed and velocity that this bear market occurred. It really happened almost overnight and in a period of a few weeks. stock markets around the world had dropped by roughly 30%. The good news is that a few weeks later, they had recovered quite substantially. And we'll talk a little bit about why that recovery so far has occurred. The big question mark for many right now is whether or not that recovery is sustainable, or is it going to falter and we're going to retest theoretically the lows we saw before. That's not our thesis. Our thesis is that we are looking for a more sustained recovery, perhaps with some headwinds and some air pockets along the way, which will cause some more market volatility. But generally, we think we hit bottom already and we're on a path to recovery from an economic standpoint. Just for further contrast, many of you, I noted, said there was a good portion of the audience that were retired or near retired. So many might remember, but you definitely probably lived through from an investment standpoint, both the IT bubble back in the early 2000s, and then of course the financial crisis that we saw just over a decade ago. And this is the same information as I showed previously, just looking at the drawdown in this particular recession, in contrast to both the 2008-2009 financial crisis shown in red and the IT bubble collapse in 2000-2001. And as I mentioned before, you see this sort of in the financial crisis in particular, a move down, slight deterioration before a final real collapse at the end. And we saw something similar in the IT bubble. And this is where I mentioned before that the risk still to the economy is that as we move out in time, maybe the recovery isn't as durable or as strong as some might be expecting, and or we hear of second wave risks of COVID. And there could be other knock-on effects to the economy or to people's ability to get employment, or even just our own behaviors, which definitely will change. How many of us will travel or get back to restaurants on a regular basis or resume a lot of the activities that we did before? Maybe a number will, but some won't, and that will change the shape of the economy going forward. So there is still this risk that we see another drawdown like we saw in previous recessions, and that we do have to continue to be cautious and wary that that may in fact happen. So if we move forward, we'll look at some of the drivers of what's going on in the markets and really what's been the impact of why we saw such a profound drawdown in stock markets, but also more importantly, why we saw such a quick snapback in many of what we call the risk assets or equity-based markets. So as I mentioned, up until end of February, the stock markets are doing quite well. The reason for that is because, quite frankly, we were nearing or close to was proposed as the end of an economic cycle. Now, we of course always need a catalyst for the end, but the end of a cycle is typically defined as one where you're seeing full employment. So pretty much anybody in at least certainly developed markets who wanted a job probably could find one. Employment levels were good. Interest rate policy was still quite accommodative. There was lots of backdrop and support for, well, employees, employers, and stock markets alongside that. Of course, with COVID, the unfortunate reality is that in order to try to prevent the spread of COVID, the requests were for people to stop traveling, and then further that, stop working, or at least stop going into your office. And if you could work from home, that was fantastic. But of course, many people in our economy aren't able to do so in a meaningful or effective way. So at its peak, there was about 38 million Americans out of work. That number's come down now. It's probably something like 20 million who will remain out of work, as some have started to go back to work. And over 8 million Canadians applied for government support. We've heard Lee mentioned at the beginning around some of the challenges that physicians faced, and that certainly was prevalent across the economy, where many people needed to get financial support. And I think that's probably the best news story that we've seen. So as much as the amount of people out of work in the United States and in Canada, and quite frankly, you could follow this trend all the way around the world, the government support that followed that was quite profound and quite rapid. So the amount of money that was available to people to support them while they were asked to work from home has been substantial. And it's that substantial amount of income, and therefore income replacement and even support for companies that has enabled the stock markets to recover fairly quickly, because the risk of these companies and the risk of people's employment was to some degree mitigated. It by no means was eliminated. There still is that longer term risk that behaviors and patterns and the way companies operate and make profit will change going forward, which is why the stock markets have not recovered fully to their pre-COVID levels. But it is definitely why we're seeing some support right now for risk assets and why the stock market has recovered slightly. Of course, on top of that, in Canada, we've got some other knock-on effects to our economy. So as much as the overall global economy was impacted, and that would arguably be most sectors of the economy. So, just about every company was impacted in one way, shape, or form, some much more significantly than others. So probably no surprise, your grocery retailer, your internet service provider, your streaming service, all of these were available to you, even though you were asked to perhaps work from home, or people that were asked to work from home or not work at all for some period of time. So people were still willing and able to spend money on certain things, but other activities pretty much stopped. So global travel has ground to a halt. Airlines have done quite poorly in that regard. And no surprise, oil and the demand for oil has come down significantly. In fact, it's been the largest reduction in oil demand we've seen in many, many years because people just aren't traveling. So airline travel is cut. Even vehicle travel has reduced significantly. So all of those things have had a negative impact on oil, which has also therefore had a negative impact on the oil price. And of course, in Canada, we do have a fairly large part of our economy supported by the production of oil, and therefore that's had a fairly negative impact on Canada. It's also impacted our housing, and whether it's housing or even just real estate in general, that would be the other sector of the economy that has definitely been a bit challenged. Now, it's not that house prices have collapsed, but certainly the resale of prices has been more challenged. The supporting industries around the housing have actually, interestingly, done quite well. We're talking to people about pools and hot tubs and those types of things. I think the local suppliers of pools and hot tubs are pretty much sold out for this year, as everybody's been pretty much stuck at home and been doing things to make their house a more enjoyable place to be at on a regular basis. So there have been some knock-on effects. But the long-term effects of real estate, and again, not just thinking about housing real estate, but think about retail real estate or even office space real estate. As a number of companies have asked their employees to work from home, they're testing the concepts of virtual employees, and people like ourselves have been working at home now for months. I'm calling in obviously from my house today, and my team and I have been working relatively effectively in this environment. So as we think forward, how much time would we spend in an office on a go-forward basis? And as every company is thinking about those things, that will change the trends in real estate. And of course, the last one around real estate would be retail. So I think no surprise as well, one of the beneficiaries of a global shutdown is online shopping. The largest online store being Amazon has done fantastic through this as far as at least I know at my door, it seems like an Amazon box shows up pretty much every day. They're doing quite well off of this. And there's other online providers as well that have done quite well. But what that means is that your average retailer is not doing as well, or your average restaurant is not doing as well. And in fact, many of those businesses have been challenged from this. So the ongoing long-term effects, as I mentioned before, are still unknown. But good news, I guess, is that the backdrop and the support that has been put around this has been substantial. On the next page, just looking at the rapid response that we saw from governments around the world. So arguably they were late to the game at the very beginning. I think the response early on was a bit slow in hindsight. Again, that's hindsight. You can question whether or not they should have had the foresight to take further action faster. China certainly did. A lot of other countries took them a while to get to the point where they lock down their economies to the same degree. But what they did right after that was the amount of money put into this problem. And money comes in two forms with respect to the economy. One is in what's called monetary policy. So that's the ability for setting up interest rates by central banks. And there was an unprecedented amount of money put into bond purchase programs and other provisions to reduce interest rates. I mentioned interest rates came down significantly. They've come down about 150 basis points, or 1.5% so far this year in North American economies. That is a substantial reduction in interest rates at a very rapid rate. That, of course, is very stimulative to the economy. If you're a business and you did need to borrow money, having access to money at a much lower price is obviously easier for you to run your business. So that's been a huge thing. The next other one, we mentioned it briefly already, but just the programs the government put in place to backstop, whether it's a company in the form of income replacements or direct individuals for income replacement, is unprecedented. In fact, in the US right now, it's running at about 15% of their gross domestic product. So 15% of everything that the US produces on an annual basis has now been replaced by a government program providing that kind of input into the economy. That's about 3 times higher than the final amount of fiscal stimulus that was provided after the global financial crisis. So that would suggest to you that the impact of COVID-19 is expected to be that much larger than the previous impact of the recession coming out of the global financial crisis. The good news is the speed at which that came was unprecedented. It was so rapid that it was just incredible. So looking forward, we are now in the point where there's been a lot of things happening, a lot of good news happening. Now we have to figure out what's this recovery look like. And really what we're looking at, and the economists are all predicting and guessing what they think will happen. There's a bunch of letters that have come up to describe this, but basically, is it a V-shaped? Does it rebound quickly? Is it a U-shaped recovery? Slow, drawn out, takes a while? Or do we in fact end up in this L-shaped scenario where we never quite return back to the levels that we were at before? Like, we just don't get that economic stimulus back. Our belief is much more this U-shaped recovery concept. There's been a lot of indicators that look more V-shaped so far. The stock market recovery was definitely V-shaped. And there are some underlying leading indicators in the economy right now coming out, things like purchasing managers indexes that are looking more V-shaped. We believe that the unfortunate reality of COVID and the fact that it's going to be with us a bit longer than the economic impacts would suggest, or at least the economic recovery in some of these indicators would suggest, we're more likely to see call it a W, a little bit of a bounce around as we move back towards, and then ultimately when the dust really settles, it's going to be a more slow, longer, drawn out recovery, lasting periods of years, as opposed to one that snaps back and we're back at full capacity by the end of the year. And we can learn from what's happening around the world. On the next slide, we know that a number of other countries got into this first that are getting out of it quicker, China being an example. Other countries around the world, New Zealand comes to mind as one that did theoretically a very good job at controlling it, closing down their borders, and using the right practices to contain it. Canada, I think, as well deserves a pat on the back for doing a good job. We've had fairly limited cases relative to a number of other countries, and seem to have the right controls and the right attitude towards it. That looks like we're probably in a slightly better place than many others. The worst, unfortunately, right now, you're seeing into the emerging markets in Latin America, and sadly, in particular, down in the southern US, are flare-ups because they really didn't listen to a lot of the advice and have started to lift their restrictions too early, and unfortunately, it's causing them some challenges. So these are some of the risks that are going on in the market right now that may cause the stock market to become more volatile, may cause people to be worried about either second waves of infections or even the first one just continuing, and these things will shape the markets going forward. But we're at the point now where we are trying to look through that, and maybe I'll just skip ahead to slide 19, if you would, please. Can cycle back on some of these in the questions, but I think the important part to kind of summarize. So in slide 19, so as I mentioned March, the end of March earlier, we saw that things were quite challenged from a stock market standpoint. We were seeing lots of volatility in the market and a huge amount of uncertainty, especially pre the amount of stimulus that came to the economy. At that point in time, we had positioned portfolios much more defensively than normal. You can see on the far left, we had raised cash in portfolios. We were holding more fixed income investments, and we'd underweighted our exposures to equities. Now, importantly, you look at the magnitude of these changes. At that time, we were probably running somewhere around 7 or 8% cash or fixed income, so an elevated position, but it wasn't like we took the whole portfolio and sold all of our stocks and went to cash or fixed income. We took a small amount of the portfolio at the margin and got more defensive as we waited for more certainty and more clarity. I've indicated we've seen a lot of that certainty and clarity, whether it's through policy stimulus and fiscal and monetary. We're seeing now recovery in a number of the leading indicators in the economy. So our view now is that we are at an early stage of an economic recovery. It still is fragile, but as a result of that, when we think tactically in how we build portfolios, we generally try to look out on a 12 to 18 month basis. Arguably back in March, we were looking down at a 1 to 2 to 3 month basis because just the cloud around the uncertainty was so thick. It was hard to really get a perspective on what things might actually happen as we look out 12 to 18 months. I'd argue now, as we think 12 to 18 months, the things look a lot brighter. So on the next slide, you'll see our actual current positioning. We put a lot of that cash back to work, and as well, we've increased our equity exposure just slightly. So this is by no means a high conviction position. I'd say it's high conviction in that we do believe there will be a recovery in the next 12 to 18 months, and the economy will continue to improve from here, albeit with some bumps along the way. And that is definitely supportive of equities outperforming bonds or cash. So if you think of bonds or cash paying close to zero, it doesn't take much of an equity return to outperform that. And that is definitely a reasonable set of expectations. Is it likely that most companies will have their employees back to work, or at least a larger number of them that are currently unemployed than today? We think the answer to that is clearly yes. With low interest rates being supported around the world and likely to be low for an extended period of time. Think of that in terms of years as opposed to months. We think the fears of inflation and those risks are also quite low, which is therefore supportive of equities. The biggest risk right now in equities is that we do see more uncertainty and more cloud around what the perception of that risk is, and that whether these earnings that companies need in order to support their current stock prices, because valuations are reasonably high based on current earnings, we really need the companies to grow into the future earnings expectations to strongly support a high equity weight position, which is why in total, when you see our overweight to equities right now, it's a relatively modest overweight to equities, suggesting that we're comfortable that we're going to see this recovery, but not highly confident that this is the time where we would want to take a significant amount of risk with respect to equity-based investments. So with that, I will stop my comments for now and wait till the very end to answer any additional questions you might have, and I'll pass it over to Kim for some financial planning considerations.
Thank you, Craig. That was very relevant and timely information. We really appreciate it. So as Craig mentioned, I am here to speak to you about some financial planning factors that may affect you on a regular basis, and then certainly that could be affecting you right now. Based on our polls, this was one of the hot topics that we wanted to cover, so hopefully I can give you some insight into that. So let's jump right into the first slide. So let's talk about what we know about radiologists right now. So from working with radiologists for years and years, we know that your financial life cycle is very different from other Canadians. Factors that we take into account on a regular basis when doing your financial planning are some of the items that are on the screen right now. So the longer training periods that you go through. And during those training periods, the low pay during those, when we compare it to other professions, such as lawyers, other professionals who are paid high salaries in their articling years, physicians are not typically paid highly during their training years. And so this does have an effect on their long-term planning. Because of this and a few other debt factors that we'll touch on in the next slide, you have something that's called a loss of time value, meaning that you do not have the same number of years to accumulate wealth or to allow wealth to accumulate on wealth, otherwise known as compound interest, as others do. And this is one of the bigger factors that we take into account when looking and creating your financial plan. So on this slide, you see a graphic that indicates the financial life cycle of an average physician in Canada. You'll see, Your debt when we get into med school averages about 100,000, and then the debt actually continues and carries on. As you see, we don't actually typically start accumulating wealth well into our practicing years, sometimes 10 plus years. And depending on when we started med school, that could be anywhere into your late 30s, mid to late 30s before you're actually able to start accumulating wealth. Now on this slide, when we overlay the average Canadian, as we see the debt load after they're done school is about 28,000, so significantly less, and they're able to pay that off in their early careers, meaning that they have a number of years head start in accumulating wealth. But you do see later on that physicians tend to, I guess you would say, overlap that because of their high incomes, and we'll touch on that on the very next slide. So compared to the average Canadian, physicians are in the top 1% of gross income. This means you're also usually very, very high tax brackets, and you're likely responsible for overhead expenses. It also means that you have an opportunity to invest more than the average Canadian or other professions once you have taken care of your debt picture. Your financial plan, which is based on your own values that are important to you, should outline all of these factors. So everything that we've touched on so far has to do with you being a physician and a radiologist. But not only are you a physician, you are also obviously an individual beyond that. And as I said, your own financial plan should be reflective of your own goals, and they should be very apparent in that financial plan. So let's jump into what we're dealing with right now. So these are some stats that we know about you and your specialty. So on average, a radiologist's income is about $350,000. And this includes radiologists who do some part-time work. So your own income may be a bit higher than this. On average, your overhead expenses are about $70,000. And the CMA recently did a study showing the effects that COVID has had on a number of different physicians and their income levels. And according to the CMA study, radiologists were hit pretty hard by this and had an average loss of income of 100%. So based on the next slide, based on the number that the CMA has given us, we know that the income you have available to support your family, your lifestyle, and your goals has dropped significantly, 100% or sometimes even more than that. We also know that you've likely had to tap into your emergency funds or other sources of cash to fund your family through these past few months. So for 2020, in all likelihood, between funding your lifestyle, the overhead expenses that you've probably still needed to carry, and then repaying emergency cash that you've had to tap into, you're likely not able to save the same amount this year that you have in the past. So what does that mean for your long-term planning? So we know that radiologists specifically tend to save in their practicing years, on average, about $125,000 each year. Then as the radiologist carries on in their career, closer to age 65, that actually drops down to about $75,000 in savings per year. So on average, you save about $100,000. If we had that $100,000 invested for 5 years at a rate of 5%, that 100,000 would turn into 127,000. So let's say in 2020, we know we're not able to likely save that 100,000. Let's say we were only able to save 50,000. That means that 50,000 now in 5 years' times would equate to $64,000, meaning there's a difference of about $63,000. And depending on the timeline of our goal, and we're going to talk about retirement. So if retirement is 5 years away, we would need to make up a difference of about 63,000. It's 10 years away, about 80,000. 15 years away, just over 100,000. And if retirement is 20 years away, we may need to make up about $130,000 in required savings. So what does this mean and how can we mitigate this? So on the next slide, we see some options. This is where you need to work with your financial planner to navigate a way to make up the difference and get yourself back on track. you might be able to save more in the upcoming years to make up for that difference. You might look at your financial plan and maybe that difference isn't very significant to the long-term financial plan and maybe you're okay. You might also decide, okay, I would like to stay on track with my financial plan, so let's look at some other options. Do I need to look at maybe postponing retirement? Or do I need to reevaluate the retirement income that I need in those retirement years? Maybe COVID has shown you, maybe you don't need as much income as you thought you did. But these are all the discussions that you need to have with your financial planner in order to decide which route you need to go. Remember that your financial plan is uniquely yours. What's right for your neighbor or your coworker, even though they may be in similar age, family structure, or even in the same career field, that may not be the right answer for you. The only way to find out what is financially best for your family, your lifestyle, and your goals is to consult your financial plan. We would also like to call it out right now that we don't know what the rest of COVID might look like. Could there be a second wave? Could there be lockdowns again? Craig was speaking to the volatility in the markets that we saw in the first quarter. Could that come back? At this point, your best course of action would be to speak with your financial planner and run through as many different scenarios as you need to get the answers that will make you feel better about your financial future. Please also keep in mind that I depicted a scenario where we're saving towards a long-term goal. Your financial planner and your financial plan can help you find the answers if you're repaying debt or you're new into practice or you're looking to save for other goals such as buying a home or anything like that. All of this information is summarized for you on our website under the COVID banner, which is the first banner that will pop up. Here are some articles and links that will summarize a lot of the information that we covered today. These will also be emailed to you as well. We also have a very cool interactive tool that will help you determine exactly what you qualify for given your unique situation. The tool allows you to select a province and career stage, a pay structure, and that will tell you exactly what you could qualify for under the federal and provincial relief programs if you are still looking into those. And finally, so the pandemic has impacted many people, especially healthcare workers, and we know especially radiologists, in every aspect of their life, including their finances. At MD, we want to make sure that you're getting the right advice regardless of whether you're a client or not. So through our partnership with the Canadian Association of Radiologists, we're pleased to offer CAR members a free, no obligation, complete financial plan. So CAR members can take advantage of MD's Fee for Planning service. It's an exclusive, limited time offer for physicians, and this service provides direct access to a full personal financial plan if you do not already have one. This focuses mainly on your long-term and retirement planning goals. A plan like this typically would cost anywhere between $2,500 and $5,000, but we are offering it in conjunction with your CAR membership at no charge. Currently, you will see a link included in the chat box of this webinar. If you're interested in completing a financial plan, please feel free to click the link and book directly in with myself. We will also include this link in an email that we'll send out shortly with the recording of this webinar, and it will also appear in a pop-up following the close of this webinar. Please, if you have any questions or are worried in any way about your financial future of yourself or your family, please take us up on this offer. And with that, I will turn things back over to Lee.
Thank you, Craig and Kim. That was very, very timely information. So as Kim mentioned, shortly you'll be able to select if you'd like to meet with someone at MD. If you already have an advisor you are working with, we'll have them reach out to you for sure. If you do not, we will connect with you, find out a little bit more about you, and then have the appropriate specialist reach out. If you do have any questions about your own financial future, I implore you to take us up on this offer. Please also remember that all MD employees are salaried. We do not tie advice in any way to income, so we're able to provide you with unbiased, straightforward, simple advice that you can have the confidence in knowing is the best advice based on your own situation. So we'll now be opening up to your questions. So once again, on the right-hand side, feel free to submit them in the chat now, and we will get to them over the next little while. We have plenty of time to the top of the hour. If we are not able to get to your question for whatever reason, if it's too personal in nature, we will take note and follow up with you after the presentation. We have had a few questions come through already, so let's get to those. And the first question, so you're back up to the mic, Kim. The first question is for you. So the question is, I am a retired physician living off my investments. Currently, a large number of my investments have decreased in value. Should I be concerned or take any action?
Yeah, thanks, Lee, and great question to whoever asked it. I'm sure there's a number of people with the same question. So simply the fact that you're asking, is there something I should do? I would say that there is an action you can take, and that is to meet with your financial planner. Some discussions that you might want to have are discussions about what is your personal cash flow like right now? Do you still need the same amount of cash flow that you needed prior to COVID? And then we need to compare that with the portfolio itself. What sort of cash flow is it generating? Are they able to match the needs? If they aren't, and if they weren't prior to COVID, where were we getting the difference from before? And is that still the best place that we can make up that gap in income? And this may lead into other conversations around taxation and all sorts of things. But the best advice I can give you is get in and speak with your financial planner, have those discussions, and make sure you educate yourself on what's best for you and your situation.
Thank you, Kim. All right, we have two more questions that have come in, and Craig, you are up. First one is now a good time to invest, or should I wait a little longer to see if there's a second wave?
Oh, I love questions around timing, Lee, because they're always very difficult to get right. So my advice to people all the time, so it really shouldn't change even if we're in a period of volatility, and we are in a period of volatility. So the difficulty is you're going to see markets move up and down. If you do have, call it cash on the sideline, so that's assuming the question's coming in from someone who perhaps has a larger amount of money to invest and needs to set up their portfolio, the best answer is always to dollar cost average into it. Take some time to move monies in over a period. You can work with your financial advisor to get the strategy that's right for you, but pick a period of time that makes you feel comfortable, recognizing that you're not going to get it right. You will see markets move up and or down, and if they go up, you're going to wish you'd invested earlier because you think you missed an opportunity. If they go down, you're going to wish you waited. We find that just behaviorally, the dollar cost averaging approach makes the most sense. Now, if you take that aside and just listen to my comments previously around the fact that we are tactically overweight equities, and that's because we believe out 12 to 18 months, we think equity markets will outperform. If you can see that far into the future, and I believe if you're investing in equities, you need to have that longer term time horizon. Stock markets are lower today than they were at the peak at the beginning of the year. And we're in the middle of the recovery from an economic standpoint. So theoretically, over the next, call it 3 to 5 years, this is a fantastic time to invest, but you may have to endure some pain in the short term. So as long as you're prepared for that, great time to invest. Best guidance, take your way to ease in over a number of months as opposed to take the bite all at once, because invariably, if you do, the markets will go the wrong way as soon as you make a big decision.
Thank you, Craig. Volatility, depending on your situation, can be a good thing or a bad thing, right? So next question is again for you, Craig, and I've heard variations of this one throughout a number of webinars over the last month. Just with all the stimulus that's happening, not just in Canada, but around the world, with all the debt and money being issued by governments, should I worry about inflation?
So I think the question, will worry about inflation would depend on how it might impact you, but I'll answer from the perspective of, do I think all of this stimulus is going to be inflationary? I think very much longer term, maybe, but most likely not. The expectation is we will need to see fairly low interest rates for an extended period of time, and that has to deal with demographics, it has to deal with productivity gains, it has to deal with technology, it has to deal with behavioral changes. There's a lot of forces right now in the global economy that suggest there is not a huge amount of demand. So think of what generally drives inflation. It's when demand outstrips supply. I just don't see where demand is going to outstrip supply anytime soon, even with all this accommodation. So the assumption would be that because of all the low interest rates, people can borrow huge amounts of money and go and buy stuff that they wouldn't otherwise buy and basically buy into the future. The amount of debt loads around the world are relatively high. The capacity for people to borrow significantly more, even though interest rates are cheap, I would say is relatively low. So we do not believe that we're certainly not protecting or positioning portfolios against a possible rapid rise in inflation. It eventually will go up from where it is today. I don't think the fear right now is that any central bank is worried about increasing interest rates to slow things down and curb inflation. In fact, most people are worried about deflation as the bigger risk right now. So I hope that answers the question in the way you were looking for, but there may be other questions around how it might impact you personally as well.
Thank you for that explanation, Craig. All right, there are no further questions that have come in. So I think at this point, I'm going to thank everyone for their participation, the question that they did ask. If there actually was one or two that were very personal in nature. So if we weren't able to get to your questions in a live forum, we have captured them and someone will reach out to you, and everyone as well will receive a recording of this session. So you'll soon see a pop-up appear on your screen when the webinar closes down with the option to speak with us or book in to talk about your financial plan. We are super grateful for the opportunity to work closely with CAR as our partner. This partnership enables MD to provide radiologists like yourselves with timely and physician-focused information. And with that, I will thank you all again for attending today's webinar. Wish you a good evening